protecting Main Street from Wall Street. It's time for Money Unleashed with Eric Johnson and Kyle Allyn.
You have to have a plan where you know if the market's going to go up, what happens next. And you also have to have a plan where if it doesn't go the way you think, you know what you're going to do.
It's time to put you back in control of your money.
I'm not trying to predict the weather, which is kind of what we're talking about, right? It's predicting the stock market. I'm trying to build a better boat.
This is Money Unleashed with Eric Johnson and Kyle Allyn.
Welcome to the Money Unleashed podcast, powered by the Hoffman Financial Group. I'm Eric Johnson. Joining me as always is Kyle Allyn. We're the vice presidents of Hoffman Financial Group. You can hear us each Saturday from 2 to 3 p.m. on 95.5 WSB and catch new episodes of the podcast each Friday. So make sure you're subscribed wherever you get your podcast. Let's jump into the show. What we're going to be talking about now, Kyle, is cash and bank earnings. Something interesting out there right now. From Bank of America, $1 trillion of money are sitting in checking accounts making 0.65%. However, Ray Dalio a couple years ago came out and said cash is trash, but middle of 2023 he said it was pretty good. What do you think? Is it still trash or is it still good?
Well, I would say that, first of all, it's good that these banks are all beating, right? So we saw Goldman Sachs, we saw Bank of America, we saw BlackRock, they're beating on earnings, right? So that's always a positive. We want to see that.
That's good for everybody.
Good across the board.
Yep. Mm-hmm.
I would say that when it comes to cash, the tricky part is they're moving the goalpost. If you go back and you look at cash before COVID, forever, if you had $1 million invested into some of these fixed rate assets, it was barely paying you anything.
Yeah, you weren't getting much. You might be getting a stick of bubble gum.
Yeah, so I think even Ray Dalio, who's a very brilliant man, he's an amazing investor.
Yes, he is.
He's someone that we follow. He talks about how you shouldn't have more than 40 stocks in a portfolio because it's over-diversified. Mm-hmm. He runs this amazing hedge fund company in Bridgewater Capital. But even he has been inconsistent. You said it right. In 2020, he's saying no. In 2023, he's saying yes. I just think we've got to pay attention in that we may be going back to the environment from prior to 2020. So if you're someone out there that's sitting with 40% in CDs, if you're sitting with massive quantities in your money market, that world is changing. And If you look at it, most investments are looked at through what we call the yield curve. So the early part of the yield curve would be the treasuries. The later part of the yield curve would be things that are aggressive.
The bonds.
Bonds, stocks, and then, of course, maybe Bitcoin way out on the end.
Mm-hmm.
Well, if they lower the stuff on the beginning of the curve, much like a bullwhip, the end of the curve is going to start to rise. So I would say you're about to watch yourself get trapped out of the market. If they continue to lower interest rates, which they're, for all intents and purposes, saying they're going to do, they're going to see that people move out into the stocks. So we heard a couple months back that there was 8 to 9 trillion in cash. Now we're hearing there's 6 to 7. It's already happening. So the point is, instead of debating cash, you need to think about how this pertains to you. So if you have too much in cash, if you have too much in CDs, if you have too much in fixed rate things, you may be about to be left behind.
Well, it's going to become less enticing. So, it's funny because the question was, is cash trash? I would argue right now it's still not. I would still say it's good right now because
I would agree.
Even though we've had a half-point Fed fund rate cut, it takes 3 to 6 months for that to really start reflecting in the stock market and the economy. And for right now, CD rates are still relatively high based upon where they were in the past. But time gets us all, right. And you're mentioning this. We are in a transition period. So think about this, everybody out there. If you're in those fixed rate assets, okay, eventually we're going to start seeing more and more cuts. Maybe a quarter point, maybe not as aggressive as the first cut we received. But you're going to start seeing more and more cuts coming down the line because the only thing that's worse than inflation is deflation. You have to get the interest rates back down again to something that's normalized. Fed keeps saying 2. I'm saying somewhere between 2 and 3. There's so much liquidity out there, but who am I? I'm just an investment advisor. So that's just my opinion. But the thing is, eventually, those fixed assets that we're speaking of aren't going to be as enticing anymore.
And let me pause you right there because I think that one of the things I always worry about when we're talking to the public, right, to those of you listening, is if you get a little wonky, if you get out into the investments, that it can sound complicated and it's like, what do we do? Well, it just dawned on me that what we're really talking about is allocation.
Yep.
So I'm going to ask you a question. I want you to answer it live right here on the show.
Let's give it to me. Let's go.
How do you allocate your clients, right? There's always that question of, if I give you $1 million, where would you put it? So if we're talking about cash, Many people have heard that when it comes to cash, you should have a certain amount in cash. So I'm going to ask you right here on the show, if someone comes into your office, if someone, comes into the office in Fayetteville, or the office in Kennesaw, or the office in Duluth, and they say, I've got X to invest, how do our advisors, how do you allocate funds?
That's a great question. There is no solid answer to that because everybody's a little bit different. It's kind of like going to the doctor. Everyone's got certain health issues. Everyone's got certain things that are ailing them, and it's the same thing with people's portfolios. So if someone comes in with $1 million, it's going to be, all right, well, how close are you to retirement? Are you 10 years away from retirement? That's going to have a different answer for me than if you are 3 months away from retiring. And it also comes down to the individual and the family that we're looking at. I would tell you that standard, I prefer 5 to 10% in cash because I want some bullets in our gun just in case markets pop down or there's an opportunity like a 5 to 10% pullback. You want to have the cash available to invest in certain positions because you're getting a discount, right? I think that's a wise thing to do. Now, everybody's a little bit different. Like sometimes people come in, they're like, yeah, I've got $300,000 in cash. I want to put it to work. Well, my first question is, okay, well, how much money do you need to have in your emergency fund to feel comfortable? And that's a personal preference question. Some people are like, I need to have at least $100,000 or $50,000 gets the job done or $25,000. And then that kind of answers it for me based upon what makes the people in front of me feel comfortable. Does that make sense?
I think what you're saying is it's not cookie cutter.
There was nothing cookie cutter about what we do.
There's so much cookie cutter when it comes to Wall Street. It's like, well, if you're this age, you get these things, and here's yours, stamp, buy.
No, that's not how it works.
Not here. It's custom. I mean, even you answering the question, I could see it on your face. You're like, Kyle, I'm going to have to talk for a while about this because there's a lot to learn, right?
Yeah, well, it's not as easy as just 10%.
That's right.
Doesn't make any sense.
And as a fiduciary, to act in the interest of a client, being able to trust that person, we've got to get to know you. Now, let me ask you this question.
Okay.
If we're going to do that, how do we do that, right? If I'm thinking, hey, I might want to come in, I might want to take a look, I might want to hear about your allocation prescription, how do they do that?
Well, number one, it's really simple. You pick up your phone, you look at the numbers on it, you dial 404-341-6767. That's 404-341-6767. Or you can walk over to your computer, pick it up, and put it in unleashyourmoney.com. And what that does is that gives you an opportunity to press the button of Portfolio X-Ray. And this is the first step that you take to get in front of one of our great advisors and have an analytical view, an unbiased analytical view of where your money is and how it's working for you, right? We have a couple different reports that we go over. And we also get to know you. I mean, we spend about an hour, sometimes an hour and a half, getting to know what do you want to do in retirement? Is it travel? Is it spoiling grandkids? Is it buying a Corvette and driving 90 miles an hour up a mountain? Like, what is it for you? And that is how we actually put plans together for people. So that's the first step is give us a call, 404-341-6767. That's 404-341-6767. Or check us out online at unleashyourmoney.com. And we're happy to help you with your retirement plans. All right. Now I want to talk to you about something that we talk about probably ad nauseum with almost every single client, and that's long-term care. Do we need it? Can we hold back on it? How much money do we need to have in order to not worry about long-term care? What are you seeing when we talk to people?
Yeah, so let's go through the basics, right? Long-term care insurance generally covers services that provide the policyholder assistance with routine activities called activities of daily living. This would be eating, bathing, dressing, continence, right? Using the toilet.
All the fun things we don't want to talk about.
We don't want to talk about that, right? So this is something that's important because we hear from the Department of Health and Human Services that about 20% of 65-year-olds will require some type of assistance at some point. So we don't want to think about it, but we need to think about it. And to answer directly your question, when you say, okay, at what point do I have to look at it? For me, I've always said, and I actually don't remember where I read this, but I've said this for over a decade, if you have less than $1 million, you probably don't have the assets to support spending money on long-term care. If your assets are going to get above $3 million, you can self-insure. So if you're under $1 million, I might argue you probably are just still trying to get to the place where you're replacing your paycheck, getting through retirement.
Yeah.
If you're going to get above $3 million, you've got a surplus of assets. And so that extra money, that extra cash, you could just self-insure.
Yeah, so that's what's getting you across the finish line.
Yeah, so it's the gap. And the other thing I want to be clear about is it's not do you have $1 million today. It's will you ever get there? So if you look at your retirement plan, maybe you've got $600,000 or $700,000 or $800,000 today, but we're looking at the difference between your spending and your income. And you're going to get there, say, at 80. Well, if someone's going to get to $1.5 million in their position at 80 years old, I would argue they probably do need to consider long-term care. If somebody's got $100,000 in their accounts today and they're never going to get to $1 million, they probably just don't have the assets to support it. So I want to be clear about that. It's not what you have today. It's what you will have in the future. So the first thing you're going to have to do to figure this out is build an income plan.
That's right.
If you don't know where you're going to be in the future, then it's really hard to make this decision. The other thing I will say about long-term care is I don't like traditional long-term care.
I get it.
I had a lady at my workshop last night, and she actually did counseling on this, and she was like, thank you for preaching this. And I said, what do you mean? She said, well, so many people don't understand the detriment of traditional long-term care. They'll raise the cost at the exact moment you need it, or they'll lower the coverage. So what I like to look at is building long-term care through life insurance. And the reason I do that is because if you don't use the money, they'll give it to your family. So instead of putting your money into the insurance company's hands, you not needing it and them keeping it, you have this loop completion.
Yeah, so you're not just basically sending money off to an insurance company and you may or may not need that. You're actually putting it into an insurance vehicle that you can access the money, and then if something happens to you, that goes to your heirs. That's what you said, right?
That's exactly right. And the vehicle specifically would be Index Universal Life. So a lot of times you'll hear people like Dave Ramsey say that there's really no purpose for life insurance. I would say that you've got to be careful with that statement, because even though it's not common, doesn't mean it doesn't have a purpose. Even though every client, I'm not saying you need to go buy life insurance to cover for long-term care. Even though it's a small amount of people that I would even recommend that to, it's still important as a fiduciary to check all the boxes.
That's right. You got to pay for things now, but it's our job to also figure out how to pay for things later as well. The other fly in the ointment with long-term care is, typically 62 is usually the latest you can actually apply for it without being absolutely outlandish for the costs, right? So that's the hard part. So if you're in your 50s and you got $1.05, well, we're going to be close to $3 million by the time we're 70. Okay, we might be self-insured. Now, if you're at $1 million and you're 62, you might want to take a look at long-term care insurance. And I think if the lady was trumpeting you last night, doing a good job that you're saying that it's not necessarily a good thing to have long-term care insurance because of the rug pull that they do on you, but also people don't understand what long-term care insurance gives them. Sometimes it's $100 a day.
And look at the cost, right?
Right, yes.
Like I was looking at the numbers. It's somewhere between $8,000 and $10,000 a month that you could easily be spending on homemaker services. Like, that's amazing.
Yeah, no, listen, my mother-in-law, who's since left us, but she actually for a few months had to go into a facility. It was $9,000 a month. And let me tell you, it's not the greatest care you can possibly get either. They're overworked. There's not enough people.
And that's today's cost.
And that's today's cost. Imagine what's going to happen in the future when this gets more and more expensive. So you want to make sure you have the Cadillac service at the end of your days, and making sure you have enough money, in my opinion, is the best way to fight off the long-term care issues that we have. So there's a lot of different ways you can do that, and you just nailed it right on the head. It's about making sure you've got your arms wrapped around a good income plan for yourself. Well, what does that entail? Well, that makes sure that we have income that's supplementing your Social Security and pensions if you're lucky to have one, but we also want to include inflation. We also want to include the taxes of things. And, you get 3 phases of retirement. You got the go-go years up front. I like to flood my clients with income because you need it to have the fun. But what happens is the older you get, your fun money goes down, your medical expenses go up. And if you already have the income coming in to satisfy that, I like to use that to replace the needs for long-term care versus, maybe potentially throwing money away on an insurance company, is basically making sure you have a proper income plan put in place. If that sounds like something you'd like to discuss, give us a call. We're happy to help you out with this. 404-341-6767. That's 404-341-6767. Or hop online at unleashyourmoney.com, and we're happy to help.
Eric Johnson and Kyle Allyn are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV 2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV2A Item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.